below the $80 per barrel key psychological figure. In this report, we aim to shed light on the factors driving WTI's price over the past week and ASA's official outlook. Making a start with the Baker Hughes report, which showed that the number of active US oil drills has decreased, placing an end to 3 weeks of increases. The reduction in active oil drills may be an indication of reduced demand, as was apparent by the API report released this week. The API report came in much higher than expected, with an increase of 11.9 million barrels of US oil inventories, making a significant reduction in demand for oil on a weekly basis, and as such could continue weighing on the price of oil should the inventories continue increasing, implying a slack in the US oil market. However, we would like to know the EIA will be delaying in scheduling data releases from November 8th to 10th and will resume its regular schedule on November 13th. As such, traders may be anticipating the EIA report to echo the increase in inventories, as was shown by the API inventories, which could further weigh on the price of oil. Whilst should they contradict the API's figures, we may see temporary support for oil prices. This past Sunday, Saudi Arabia and Russia reaffirmed their intentions to continue with their oil output cuts until the end of the year, as demand and economic growth concerns continue to mount on a global level. According to Reuters, the two countries will be reviewing their oil production cuts next month and will be discussing whether or not to extend or even deepen oil production cuts for the future. Should they decide to maintain the current tightness of the supply side of the commodity or even intensify it, we may see an increase in the price of oil as supply constraints increase. However, we believe that further production cuts may be counterproductive to Saudi Arabia's aims and could have a negative effect on its oil revenue. As such, should the two nations decide to end their agreement or increase their oil production, we may see an easing of pressures on the oil markets, and as such, it may push oil prices to lower ground. The release of China's CPI rates were indicative that the economy has once again entered a deflationary period, sparking worries about the resilience of the Chinese economy. Furthermore, China's trade data came in this week and confirmed concerns about the Chinese manufacturing industry, as the exports rate came in at -6.4% lower than expected. The financial releases continue to highlight how the Chinese economy continues to struggle and heighten worries in oil market participants for a possible slowing of oil demand in the manufacturing giant. Overall, should China's recovery efforts continue to underwhelm market participants, we may see the growing concerns about China's economic resilience exerting a bearish effect on oil prices. The situation in the Middle East remains tense, yet talks about a potential humanitarian corridor appear to have intensified since last week. As such, should further inroads be made in regards to international cooperation on a humanitarian level at least, we may see market worries of a wider regional conflict easing, which may weigh on the price of oil as market worries for the supply side of oil may subside. Nevertheless, as we stated last week, the situation is still considered as being dynamic, and should any unexpected developments occur, which may lead to an escalation of hostilities, we may see oil prices being pushed higher. Yet we have to note that there is an increased consensus that pauses in fighting must occur in order to allow for the transfer of humanitarian aid into Gaza. The temporary pauses in fighting could ease tensions in the region and as such may lead to lower oil prices. Thank you for watching.